Welcome to this explainer. Today we're really putting on our economist hats to look at what might just be the single most fragile, terrifyingly vulnerable choke point holding our entire global supply chain hostage. We're going to model out a systemic market shock and examine exactly how a highly localized geographic disruption could trigger a massive, incredibly rapid financial contagion across all of international trade. And honestly, it all comes down to this one number, 21. That is the extremely narrow width in miles of the Strait of Hormuz at its tightest point. Just think about that distance for a second. It's literally a space of water you could drive a car across in 20 minutes if there happened to be a bridge. It connects the Persian Gulf directly to the global ocean shipping network, sitting right there between Iran and Oman. But the actual navigable shipping lanes, they're only about 2 miles wide in each direction. But you know that tiny physical size is totally deceiving because the economic stakes here are just monumental. If this strait closes for literally any reason whatsoever, the global economy has approximately 72 hours of liquidity and inventory buffers before the financial pain becomes entirely unbearable. We're not just talking about a localized regional disruption. We're talking about a full-scale global economic contagion. Okay, let's dive into this and look at the sheer volume moving through this channel. It is astonishing. 20% of the world's entire daily oil supply is squeezed right through this tiny 2-mile wide shipping lane. That's 17 million barrels of crude oil, liquefied natural gas, and petroleum products moving every single day. I mean, this is the raw energy that powers modern civilization, flowing from countries that collectively hold nearly half of the world's proven oil reserves. Now, as an economist focused on market instability, you might be wondering, well, what about alternative routes? Right. Because surely there's a backup plan. Well, pipeline capacities across Saudi Arabia and the UAE can handle maybe 7 million barrels, but that leaves 10 million barrels. 10 million barrels a day have absolutely no alternative route. If that strait closes, those assets are completely stranded. They simply do not move. So let's look at the mechanism of market shock. How does a physical bottleneck like this actually translate into a financial crisis? Well, because oil is a globally traded commodity, markets trade on anticipation. A disruption wouldn't even wait for ships to pile up or run out of fuel. The tools to trigger that market anticipation are incredibly asymmetric. Iran, which sits right on the northern edge of the strait, doesn't need to park some massive battleship in the channel. They could use naval mines. Even just a dozen of them floating in the shipping lanes would halt traffic instantly, mostly because literally no insurance company would cover the voyage. In fact, simply making a credible announcement of an intention to close the strait triggers immediate market repricing and insurance halts. The financial damage starts before a single ship is even touched, which brings us directly to the price contagion. As market analysts, if we want to understand what losing 20% of the global supply actually looks like mathematically, we have to look at historical baselines. Now, what's really interesting to look at here is how disproportionate the market reactions are to seemingly small supply drops. During the 1973 embargo, a 5% supply drop quadrupled prices. In 1979, a 4% drop doubled them. The 1990 Gulf War, a 9% drop caused an 80% price spike. These historical events set a terrifying baseline for what a potential 20% drop would look like today. So if 20% suddenly disappears, economic models strongly suggest that panic buying and algorithmic trading could force oil spot prices to skyrocket to $200 or even $300 per barrel in the very first week alone. A price shock of that magnitude would be entirely unprecedented in modern financial history. And that leads right into a complete supply chain collapse. Let's move to and see how this builds, because a massive shock to energy markets doesn't just stay in energy markets, right? It causes cascading defaults and a full-blown supply chain collapse. We can actually trace the exact path of this financial contagion. Step 1. Oil hits $300 a barrel. Step 2. Freight and shipping costs multiply instantly. Remember, everything that moves by ship, which is basically all manufactured goods, relies on bunker fuel. Step 3. Manufacturers operating on thin margins suddenly can't absorb these transport costs, so they compress, they shut down production, and they lay off workers. Finally, Step 4. This triggers rapid global inflation and pushes the entire world straight into a severe liquidity crisis and a deep recession. Let's translate those macro numbers into micro impacts just to see the tangible financial shock to everyday consumers. Under this contagion scenario, a gallon of gasoline in America would likely leap to somewhere between $8 and $12. And for international travel and trade, the economics of airline routes would completely collapse. The skyrocketing jet fuel costs would push a standard $800 transatlantic flight to around $3,000. Commercial fleets would simply have to be grounded. Now let's explore what we call the rationality trap. Conventional economic wisdom usually steps in here to calm us down. The argument is that a country would never actually cut off its own oil exports, right? Because it would devastate its own economy. But as risk modelers, we have to recognize when our foundational assumptions are fundamentally flawed. Western economic frameworks optimize for GDP growth and citizen well-being. It's rational self-interest, narrowly defined by dollars and cents. But the Iranian framework incorporates theological considerations, deep ideological commitments, and very real regional power calculations. Impartially speaking, in their calculus, severely damaging the global economy to demonstrate power and create chaos in the West might actually be totally worth the economic cost, especially if they view this standoff as existential. And they're absolutely prepared for this through asymmetric warfare. This is all about developing unconventional tactics to bypass a conventionally superior military force and achieve major strategic disruption. Why does this matter for the markets? Well, because even if a vastly superior navy goes in and neutralizes every hostile vessel in the area, the naval mines are still in the water. Clearing smart mines from a 21-mile street with heavy commercial traffic takes weeks, possibly even months. The massive market disruption is cemented long after any kinetic conflict actually ends. So we are facing an unpriced global threat. When we zoom out, it's like looking at a giant puzzle with a missing piece. We see this staggering structural vulnerability. 20% of our energy flowing through a 21-mile choke point adjacent to a hostile nation with an astonishing lack of any viable alternative infrastructure plan over the last 50 years. We've essentially just hoped for the best. And look at the trajectory of this in action. At 72 hours, financial pain becomes unbearable due to share market panic. Within 1 month, physical supply chain halts mean unemployment rises and factories start shutting down. By 3 months of disruption, we are deep into global recession territory. And at 6 months, the global economy suffers structural damage that takes years, maybe decades to repair. This is exactly what happens when classic short-term thinking is applied to critical global infrastructure. And let's be incredibly clear here, this unmitigated global financial risk is arguably higher today than it's been in decades. Just look at the risk escalators we're dealing with right now. You've got an advanced nuclear program, US-Iran relations sitting at historic lows, and rapidly multiplying regional conflicts. But that last point is absolutely crucial for us as economic observers. Today's highly interconnected just-in-time global economy means a price shock propagates through supply chains and financial markets infinitely faster than it ever did in 1973 or 1979. The contagion would spread like wildfire. So what does this all mean? It leaves us with this final, incredibly vital question to ponder. What are we actually prepared to do when the strait closes? Not if it's threatened, but when the traffic actually comes to a complete stop. Because a true mitigation plan for the global economy needs to exist long before the disruption happens. And looking at the data we have today, it's terrifyingly unclear if that plan exists at all. Thank you so much for joining me for this explainer. I will see you next time as we continue to map out the economic forces shaping our incredibly fragile world.